I've heard someone speak previously in the past about edge within markets. Their opinion was that the Forex market doesn't have any edge. Futures and options markets don't really have much edge.
Well, it depends on what you're looking for and how you define edge. I'm guessing the edge would be something along the lines of scalping or day trading. How are you going to scalp the dollar against the euro? Where's your value added? Or what do you know that the market doesn't know? Looking for edge is just a fool's errand. My experience with the Institute and meeting so many retail traders, that the number of times I heard, I wish I'd discovered you guys earlier before they're being scammed by some charlatans, or because there is so much out there in the retail world. Frankly, I find it obscene and disgusting. If something sounds too good to be true, it's probably too good to be true. I think everybody needs to be aware of technical analysis, but I would use technical analysis just to try and time entries and maybe look for some exit points rather than sort of generating ideas. And I think generating ideas purely on technicals is a mug's game. Intraday trading, forget about it. Statistically, it doesn't work. So forget about trying to scalp things during the day. And another thing which I want to get off my chest as well is
The number one podcast in the trading space, the fastest growing, and that's thanks to every single one of you. Hey guys, before we get into this incredible episode of Words of Rizdom, I want to let you know how you can get a free trading plan. Very simple. Go in the link below, you're going to see two links. One for Telegram. There you'll get free mindset hacks, a free technical course, free updates and polls on the podcast. And then the other link is our new email newsletter. Click that link, sign up, you'll get a free trading plan PDF sent directly to you and get incredible value all week long. Let's get into this episode. Welcome everyone back to the Words of Rizdom podcast. We're back once again, still the number one trading podcast in the world. And that's thanks to all of you and our incredible guests. Our goal here is to get you as much value as possible, help you to become consistent, profitable with the right mindset from the right people. Talking of which, we have an absolute legend here with us today. I'm very humbled. It's a long time since I feel any sort of nerves or anything on the podcast, but you'll understand why as we get into this. But we have an ex-Goldman Sachs trader, ex-hedge fund trader, a previous mentor from the Institute of Trading and Porfolio Management. It's a mouthful, but I got through it. But we're here with Chris Cathey. It's a pleasure to have you with us today.
great to be here. Thanks very much for the invite.
No, it's my absolute pleasure. And how we like to normally do this is just kind of get to know you and how you got to where you are today. And if we can get into like just before trading and then into your trading journey, and then we can just take it from there.
Yeah, that's fine. So I was born and raised in Newcastle, northeast of England. Went to a local comprehensive school, and then fortunate to go to Cambridge, Fitzwilliam College, where I did a undergraduate degree in natural sciences. Fortunate to get a first, and then I did a PhD. Coming towards the end of a PhD in organic chemistry, I was trying to work on my options. And the world of the City of London, investment banking, and more specifically trading, just seemed to tick all the boxes for me. I had grown up in a gambling background. So my father likes to gamble, my grandmother liked to gamble. Actually, my school pens when I was at school were the little Ladbrokes red pens with the white top on. I don't know if anybody's familiar with them. So I think I was asked about that in an interview, and it came up and at Goldman, and I mentioned it, and I think that was probably the interview that clinched it for me. So I started at Goldman in 1993, working on the European equity trading desk at Peterborough Court on Fleet Street in London. After, initially there was a 4-month training program in New York, where the Goldman headquarters were at 85 Broad Street, then back to the desk and starting as the junior, which meant basically getting everybody's breakfast, lunch, picking up dry cleaning and whatever go-for jobs I had to do. Then starting to pick up the phone, learn the language and the etiquette required to handle phone calls, which sounds basic, but there was a specific language and a specific way of doing things. And then started to progress to processing client orders. It was virtually all institutional business. So institutions from UK, US, Europe, and making prices and then starting to take proprietary risk. And it was a journey which, for me, it lasted 13 years at Goldman. Most of the time was in London, but I spent about a year in New York just after we moved to One New York Plaza, which is the bottom tip of Manhattan, and 18 months in Frankfurt, trading the German market. Then I got to a stage at Goldman where, same as any large organisation, you either progress into management and up the greasy pole, or you kind of go sideways. The world of investment banking had changed, so I left Goldman in 2006. After the Nasdaq bubble, there was a huge increase in the amount of assets managed by hedge funds, who had benefited from leverage positions during the build-up to the Nasdaq bubble, and then subsequent ability to short and the unwind of the whole thing. Hedge funds became incredibly powerful, the assets just exploded. And I thought the next step for me would be to follow that path. So I joined Merrill Lynch as a trader at the internal hedge fund. It's called Strategic Investments Group. The idea was at Merrill Lynch we would develop a 5-year track record, then open the trading open for external funds and take it to an external business. Unfortunately, Merrill went bust in 2009, and we only had been there. We had 4 years of track record, so it wasn't quite enough. Due to personal circumstances, I left the business and went into semi-retirement. With semi-retirement, I got involved with venture capital into startups in the Northeast, and also as a trading mentor with my old colleague Anton Kreil, who had subsequently started the Institute of Trading and Portfolio Management. Again, it's a bit of a mouthful.
It is.
The ITPM.
Yeah.
And his goal was to try and educate retail traders how to trade like professionals, because there's a apocryphal story about the 1990 rule in the retail world, which is that 90% of retail traders allegedly lose 90% of their money in 90 days. So Anton realised there must be a market for education, and that was what we did together until pandemic coronavirus lockdown hit the UK and the rest of the world. And another old colleague of mine from Goldman asked me to run their AIM market making business at Cantor Fitzgerald. So I did that for about 3 years, and then kind of just went back into gradual sort of semi-retirement and trading for myself, and just keep myself busy.
Definitely. It's quite a lot to unpack there, but starting out in terms of the educational route, like Cambridge, was Cambridge always such like a renowned school, even back then as well?
Oh, completely. Cambridge is a sort of world-class university. I found it initially incredibly intimidating, but eventually I absolutely loved it, and I realised about halfway through my second year, the second term of my second year, that the university was just all that they were trying to do was teach us how to think. And once I realised that, I couldn't unrealise that. I couldn't unthink it. This subject you were studying was just the means and method to teach you how to think, but it was illuminating, and it changed my life forever.
I can imagine. Was it always on the cards for you, that sort of like higher academic, right? Or
I've always enjoyed academic study, and I wanted to see how far I could take it.
And trading, as you mentioned, so you did chemistry in your
Yeah.
PhD.
Yeah.
And like trading came around when you were at Cambridge? Is that how you came across it? Is that where it started?
Yes, that's when I started to think about my next steps, because initially I went into to do a PhD with the intention of becoming an academic. Then about halfway through my PhD, I realised that academics are very underpaid with no job security.
Yeah.
So I'm happy to take underpaid with security or no security and high pay. Academics seem to have the worst of both worlds. And also my love of chemistry wasn't enough to propel me into that world. So I looked for options and see what was out there, and trading just seemed to be, oh, wow, this is fantastic. What is this all about? You're getting paid to take risk with other people's money. I mean, what's not to like?
What was it? So there was that element, but what was it about the environment? Did you get to go with Goldman? Did you just apply, or did you actually go down and see the sort of offices, etc.?
I went to a few university sort of milk rounds where employees present to undergraduates, postgraduates, whatever, looking for potential new hires. Resonated with a couple of guys from Goldman, and I got invited down to spend a day on the trading floor on Peterborough Court. Loved it. Absolutely. As soon as I walked on, I thought, this place is for me. It's fantastic. So I did some research and sort of genned up a little bit on about the world of the city, world of trading. even just different products between fixed income and equities, starting right from the basics, because I had no economic or finance background. And the more I researched, the more I looked into it, the more I loved it.
How competitive was it back then as well?
I don't know the numbers of how many people Goldman hire from the potential pool of applicants, well, how many people apply, but I would imagine it's a pretty small percentage. Just to put it in context as well, I had 35 interviews, which I had to get into Goldman, which was not unusual. That was pretty much the average.
What are they trying to look for, do you think, in those interviews? Because like you said, you had no finance background before then. So what is it that they are looking for through that process?
They are looking, I would imagine, well, actually subsequently at Goldman, everybody gets involved in the interview process.
Okay.
So chances are everybody's going to interview the people who are subsequently going to be hired to work in their environment, on their desk or on the next desk or whatever it may be. So the recruitment is a key part of the Goldman Sachs mentality. I think what I used to look for was intelligence, ambition, enthusiasm, and just always a simple thing: can I spend 12 hours a day sitting next to this guy or this girl, whatever. So if I can do that, then you're halfway there.
Mm-hmm. And is it a testing period? Because as you said, when you started, it was like doing the sort of jobs around the office.
Yeah, because you're at the bottom, and that's fine.
Yeah, and that process though is that.
And actually, just one thing about the process. Mm-hmm. So it may sound banal. You think, you graduates from the best universities in the world. Why are you taking coffee orders? Why are you taking breakfast orders? Because the whole idea is to teach you how to listen. Because everybody can hear, unless you're deaf, obviously, but teaching somebody how to listen and pay attention is absolutely key. Because the one thing on the trading floor is you want to avoid errors at all costs. If you learn how to listen and think and respond, and if you're unsure, stop the process, put your hand up and ask a question, then you're hopefully going to avoid errors. That was the logic behind it.
No, I understand it. I definitely do, because I think majority of people aren't willing to do what is necessary to progress forward. Like a lot of people are too proud, especially nowadays. A lot of people get into trading just because I'm too good to work a job. I've had that conversation with a particular trader a few years back, and it always shocked me. Because like, I'm not made to work a job, but I want to be a trader. And I was like, well, that mentality doesn't work.
That's
it's flawed straight away. Yeah, there's no foundation there.
No.
But as you're explaining, even the professional realm, you have to start with this sort of job. Because as I said, not just the listening, but also I think it's the humility as well, like to understand that this person is willing to go through the steps versus someone who might come into that job and say, wait, well, I was just at Cambridge. Yeah. I've got a PhD. Why should I do this? Then that person's definitely not going to get hired, I imagine, or stick around after that point.
Well, chances are you wouldn't get hired because that mentality would manifest itself in something else, which would come out probably in one or multiple interviews. Mm-hmm. Secondly, if you manage to get through the interview process, then you probably wouldn't stay trading very long, because one thing about trading, you need to be humble. Yeah, humility is absolutely key.
100%. And during that period, though, was it just the jobs you're doing, or were you trading at that time too? Was that something that you had to progress towards?
That was just a progress.
Mm-hmm. And then the phone calls...
It wasn't a very long process. It trying to get this done as quick as possible.
Yeah.
Because obviously it's in their interest to get you to start working. But it was definitely part of the process.
And when it comes to the trading, was there some sort of training that was provided to you, or any sort of education, or what was it?
Well, the bulk of the trading as a trader at an investment bank at the time was about processing client business. So, like I said, institutions who were pension funds, mutual funds, hedge funds, sovereign wealth funds. That was the bulk of our business, and it was the processing of their business, which usually involves some degree of risk, which would mean that the Goldman Sachs trader and other investment bank traders would make a price to take some risk to gain the business and hopefully unwind the risk profitably or with as little damage as possible, and then charge a commission on the follow-on balance too. And that was how the business was transacted. So there was always an element of risk taking, and learning how to do that was, well, it can be learned, but I think there has to be an inherent appetite and desire to take risk, manage risk, and process the business correctly. And it's a self-fulfilling business. The better prices, the more business, the better prices, the more money you make. It's a virtual circle.
And would you say that?
But sorry, that there wasn't any real formal education in terms of you just is very much on the desk and learning from the most senior professionals around you.
Okay, so it's more so like being in that environment. That's probably a part of that.
Completely.
35 interviews as well, because you're going to be essentially picking up off those people.
Completely, yeah.
And would you say that going through that process, was there a lot of people who would drop out during that process, or were they kind of vetted to a point where they wouldn't do that?
It was very, very much vetted to a point where the dropout rate was very, very low, and subsequently the turnover at Goldman was incredibly low. For what is perceived to be a very aggressive, very dynamic organisation, the turnover was actually surprisingly low, especially compared to the competitors, because we were always told you only leave Goldman once, and you've got your Goldman card to play, and then you move on to the next opportunity. But if you're at the best place, or we think is the best place, then why leave? So yeah, I was there for 13 years. That was not unusual.
I can imagine. I've heard that saying before, actually, the Goldman card.
Yeah,
I've heard that as well, and it's very interesting to hear.
Let's do a transfer fee.
Yeah.
That's put it in a sort of like a sporting context.
Definitely. And in terms of capital-wise, when you first started trading, would you be starting at a certain point, and then through your performance, through your experience, as you grow, you start to manage more and more?
Yeah, very much so. You start off with smaller positions, and as you develop a track record and experience, and the way to manage risk, you get bigger and bigger. Now that's on the proprietary side. That's when you're only taking risk that you want to take for Goldman Sachs. But on the client side, which at the time was called the back book or proprietary book, the front book would be the client facilitation, where you're making risk prices to clients. That was unlimited. That was whatever the client needed. If they want to price in $1 million or $1 billion, the thought process would be the same.
And how was that for you? Had you ever sort of managed any large capital before that point?
No.
So what was that like in terms of your mindset going into that?
Let's take a break for a minute there, guys, because I want to tell you about the best prop firm in the entire industry, Alpha Capital. Let's keep it nice and simple. You want to get paid out, you want to have institutional experience behind the firm, you want to have their own broker so that you can trade on the best platform that all traders love to use, and on top of which they have their own technology as well, so you know they're here for the long term. Alpha Capital has no commissions as well as part of their trading conditions, which is absolutely incredible. And not only that, they're London's finest. Now, if you want to join them, 20% off using the code RIZ, and the link is in the description below. Now let's get back to the episode.
It was incredibly stimulating, and I found it fascinating, dynamic, and I absolutely loved it.
Was there any worry at all, or any sort of struggles you had to overcome?
None whatsoever. I think I have a reasonable degree of self-confidence, and I think if you can't back yourself, then what's the point?
It's interesting you say that as well, and the way you're sort of describing it there as well, it's like it's one, obviously the passion's real, the confidence, as you say, in backing yourself, but then equally, I was reading Market Wizards recently, and some of these really hedge fund traders, they describe it in a very similar way, and they describe it like, they treat it like a big game. And it's really interesting though, because it's like, I feel like the retail trader would hear that and think, oh, okay, you just have fun, right? When equally, you treat it like a game, but you still have to do the right principles.
Oh, completely. You have to, whatever works for yourself, really, because whatever methodology you use, whatever to generate ideas, to implement those ideas, to manage risk, yeah, there are certain guidelines, but it's very much down to an individual tolerance for risk and a tolerance for, and a willingness to do hard work. Unfortunately, trading, same as anything else which is interesting, demands hard work.
And you mentioned a language earlier, that you had to learn a language, especially on the phones. What can we give any insights into that?
A good example would be that, first of all, if you're buying something, making a bid, it'd be the price for the size. So 100 bid for 1 million, example. So that'd be 100p, 100 pence, or whatever it may be, for 1 million shares. If you're selling, you're making an offer, it's the other way around. So you do the size for the price, at the price. So it's I'd offer you 1 million shares at 100. And that just makes, it's a simple thing, but it's so ingrained that once you learn it, everybody speaks the same language. Again, it's the process to remove errors. And also, when you're on the phone, you always repeat everything that you said. So if you're dealing with a counterparty or dealing with a broker, then you repeat exactly what's happened, so there's no error.
Mm-hmm.
And simple things, even something like 50 and 15. It's an easy mistake to make 50, 15. So 50 tend to be half 100.
Mm-hmm.
So you say 15, which would mean 1-5, or half 100, 5-0. And even when I was in Germany, simple things like sort of in German, kaufen is to buy, verkaufen is to sell. Mm-hmm. So instead of using, it's obviously sound very similar. So it's plus minus, plus minus.
Yeah.
Plus to buy, minus to sell. Mm-hmm. Simple things, and once you've learned them, you can't unlearn them. I'll repeat that till the day I die.
I can imagine. And did you know German before you went to Frankfurt?
No, I didn't, but I learned it over there, and that made everything a lot easier. Not really on the trading floor, because the office was fully staffed by basically virtually all Germans, but everybody could speak fluent English. Mm-hmm. Whereas if you're living in a different country, different culture, I gained way more by learning German to live in Germany.
Mm-hmm. Definitely, and that was one of the questions I was going to ask you, actually, because throughout your career you went from London, New York. Did you go back to London, then Frankfurt?
Yeah.
Yeah. What was that like, though? What were the key differences? Because I can imagine, obviously, in London, you're focused on sort of when the London's opening times, etc. Frankfurt, obviously, then New York, of course.
Yeah.
I imagine you're not on that London time. You're going straight for the New York session. But with London, you have that overlap as well.
Yeah. No, New York was a bit different because so the role of the European traders in New York would be trade what was called ADRs, American Depository Receipts, basically European shares listed in dollars. Most of them on the New York Stock Exchange, some of them on NASDAQ, and but they traded the same hours as New York, so it's 9:30 till 4. Mm-hmm.
And where would you say you had a preference of which floor or which trading times that you were trading in?
It's easier to trade in Europe, London and Frankfurt, because the restrictions, which seem quite pedantic, make trading in New York a little bit more difficult as an investment banking trader.
Definitely, and
but it is the rules, and it's not particularly interesting, so I wouldn't bother about it. But just there are certain restrictions as an investment banking trader that you don't really have in Europe. But obviously, subsequently Frankfurt, the trading desk moved all into London, so that was in the early noughties. Yes. Yeah.
Okay. And in terms of your time there, though, you went through different market cycles.
Yeah.
And I think that's something that a lot of traders today, especially the retail traders, they don't experience as often. That they may have experienced one particular cycle and that's it. And they think they know what they're doing. They have their strategy, etc. Like, can you give us any insights into how you would have to adapt through different market cycles?
Well, actually, even the transition between different market cycles can be incredibly challenging because you tend to get a pickup in volatility. So increase in volatility, which means that the way you manage your portfolio in terms of stop losses and position sizes should be flexible. The difference between a bull market and a bear market is bull market is the most successful way to do is just buy and hold. Slice positions when you want to take some profits, but ultimately you want to run a core long positions. Bear market is kind of the opposite way around, but it's much more difficult to run in my view, to run a consistently short portfolio, because as a retail trader, first of all, you might have difficult actual putting on shorts. Mm-hmm. So probably the best way to do is using put options, but do it on a rolling basis. And the big killer in bear markets is the short squeezes, the dead cat bounces, which can be incredibly violent. I mean, an example, we were just chatting about the financial crisis off camera, but Lehman ultimately went bust, but had a few days where it more than doubled. And that you sitting through a short on that is very, very painful. You are getting squeezed hard. To have the conviction and the consistency to sit through that, well, that's not for everybody.
Yeah.
And I think it's generally more difficult to make money in a bear market because, like I say, it's harder to run shorts than it is to run longs. And you always have the risk of a potential squeeze. And FOMO that's what kills people in bear markets.
It was interesting you say that because I had a guest on the podcast not long ago, Sang Lucci, and he actually lost $1 million account at the back end of last year because all he does is shorts. That's his whole strategy is shorts. And he was literally just saying that fundamentally speaking, everything should be short, but that's not how the markets work. And he said he was just too early essentially. Still trades to live, to trade another day, thankfully, but a valuable lesson, no doubt. And it was so interesting because at that point, I'd never actually thought that actual traders just had a specific bias. I always thought people were quite dynamic, but he was literally, he just shorts. That's all he does.
I must admit, I've always found it very comfortable being long and short, but I have worked with people, other traders, very, very successful traders, who would struggle to be short or long. Sorry, either be long or they'd be short.
Yeah.
Running both, it's not for everybody. I must admit, I always found it very, very straightforward. But I think you kind of have to, you touched on the thing about blowing up an account. First of all, you should never put yourself in a position where you can blow up an account. Secondly, just remember, in a bear market, it's easier to be short on the way down than it is on the way up.
Mm-hmm.
So you can think fundamentally everything's overvalued, etc., etc., etc. Having lived through the Nasdaq bubble, that just proves that craziness can extend for longer than anybody can stay solvent.
Yeah.
There was numerous hedge funds blew up, eminent hedge funds blew up in the final stages of the Nasdaq bubble, just because it's shorted too early. Exactly how you described. Yes, they had a view things were valued. On a 3-year view, they were right, but in the 6 months in the meeting, then you've blown up.
Yeah.
So just bear in mind, it's always easier to be short on the way down than it is on the way up.
Definitely. And what was the trading like, during the Goldman era? Like, what was your time horizon looking like? What sort of trades are you taking place? What sort of assets are you trading?
Well, I was just trading European equities, but time horizon could be anything from intraday to months.
Yeah.
Complete flexibility.
Interesting. And how would you base your analysis? Is it more fundamental, technical? Like, what's the
fundamentals?
thesis?
Fundamentals. And also my scope at Goldman was restricted to the sector I was trading. So we used to trade on a country basis, and then when the UK and European desks merged, we went sectors. So I started off trading financials, then telecoms and technology, and then my final sector was consumers. But at Merrill, I had flexibility to trade anything European, but equities or equity-related products, options as well, and futures.
And in terms of that, then, so like, let's say if we were to take an example trade, maybe you can think of one, for example. But like, how would you look at it? How would you start to frame it? Where would it start from? The idea.
Well, the first thing I think you have to start with is your worldview. Mm-hmm. So am I bullish or bearish? Why am I bullish? Why am I bearish? So obviously it's a correlation of interest rates, inflation, growth, etc., etc., the sort of standard economic indicators. And then what's the best way to express that view that I've generated? And then you try and find the right sectors to be long and short, and look at where I always found it for myself. The best trades are to be, if you're looking for longs because you think economy is expanding. Equities have a look on a historical valuation, but relative to where they are in history, where they are relative to the economic cycle. Then look which sectors, if you think in expanding economic growth, or what we've seen in the last 12 months with the explosion of anything AI, which does smack to me a little bit of the Nasdaq bubble. But right here, right now, anybody's talking about shorting these games. I mean, this could be the peak, but it could be another 300% higher. You've got no idea. So forget about shorting it. Short on the way down, not on the way up. But if you look at the sectors which have outperformed the US, it's very much sort of anything sort of cyclical. So look for the highest quality name in the sector that's growing the most, which has got the best earnings. And that's where you want to be long. Completely opposite for any shorts. So sector which is contracting, look for the lowest quality name with the worst earnings. That's kind of generally where you want to be looking to be short. And timing wise, well then, yes, I think everybody needs to be aware of technical analysis, but I would use technical analysis just to try and time entries and maybe look for some exit points rather than sort of generating ideas. And I think generating ideas purely on technicals is a mug's game. And another thing which I want to get off my chest as well is intraday trading. Forget about it. Statistically, it doesn't work. So forget about trying to scalp things during the day. Algos are quicker and the markets are on a day-by-day basis too unpredictable. So generate ideas.
Mm-hmm. No, it's interesting you say that, because that's a huge portion of the retail space that I see are scalping. Yeah. They're trying to scalp each day. Primarily they're doing it on like currencies, Forex trading. Yeah. They're a lot of now transitioning over to sort of the Dow Jones, the equities, the S&P 500, a lot of gold trading as well. This is where a lot of these scalpers predominantly are. So would you say that it's not sort of a long-term game?
Absolutely not. Absolutely Scalping on an intraday basis can be done, but I don't think on a consistently profitable basis for the long term. No way.
In terms of your time over as a trader as a whole, to be fair, so because I know you kept trading throughout that period, what changes have you seen through the trading process and the markets themselves, in terms of efficiency, in terms of I don't know if strategies have changed or had to be changed due to that efficiency or changes?
I think the major difference between when I was trading professionally and the markets that are on now is the algorithmic and quantitative trading. Algos and quants were around in the noughties, especially towards the sort of the run up to the financial crisis, but nowhere near to the extent they are now, which I think, again, go back to talking about day trading or scalping, just makes it much more difficult. In terms of strategies, I don't think things have changed. Yeah, you get new sectors, and like you mentioned AI, which wasn't around even as a sort of really a concept which could be traded, or stocks which were exposed to the AI world weren't even around sort of 5 years ago. So, yeah, the sectors which are in vogue or the hot sectors change, but the process still remains the same.
Yeah. Because it was interesting when I was reading again Market Wizards, and I think that's more talking about traders in the sort of 60s, 70s era.
Yeah, and it's a lot more sort of commodities based.
Yeah.
And the one, I'd say the one key difference between the 60s and 70s and also commodities versus, say, equities is that commodities typically trend for longer, and the easiest way to make money is to buy high and sell higher, so ride the trend.
Yeah.
And also in the 60s and 70s, the quant statistical analysis, I mean, yeah, there was a concepts, but very, very little money tied up or using actively those strategies.
Exactly, that's what they were referring to basically, is that they originally, when most of them started, they were in pits.
Yeah.
So the edge was actually inside the pits.
Yes.
You know, picking up on the different, the traders who actually perform badly and just reversing them because they're right there in front of you and you see them performing badly.
If you see somebody who's consistently bad, that's seeing somebody who's consistently good.
Yeah, exactly. And it's so interesting though, because I never really thought of that. I knew the pits existed and I knew they traded there, but I never even thought of the concept of like you're there and you're seeing these same people every single day underperform, so therefore your edge is right there in front of you. And it was so interesting just reading that and thinking, okay, and I think that really speaks to, because obviously I come from that retail trade. I've been trading for eighth year now, and that's all I've known. I've owned the apps and the programs. I've never even thought about or really deeply looked at the past of trading. And my thought process about that though is that we need to learn about, not everything about the past, because it is the past at the end of the day, but it's good to know the history of trading, to truly appreciate trading, and to really, I would say, understand trading at a more deeper level than what we just see online in today's day and age.
I think there's an old line, history doesn't repeat itself, but it does rhyme. And I think that learning from what has happened in previous economic cycles, previous market cycles, it'd be kind of crazy not to give yourself an edge and say, okay, how did this play out then? How can I see this playing out in the future? So I think it'd be crazy not to give yourself an edge if you can find something.
Definitely. And as someone who's gone through those previous market cycles, what do you think currently at the moment? Because I personally have felt like, just from my view, is that we've been overextended a long time, and that we were expecting some sort of crash or some sort of correction, a bear market to take place. COVID happened, and we saw a correction, but a very quick bounce and sort of turnaround again due to potentially just quantitative easing and the amount of money that was printed out during that period. And it's kind of like, I don't know, propped us up. And I know I see the tone in social media, more like Twitter and the finance Twitter side, of people tweeting like, again, Sanglucci as an example was short, maybe potentially just a bit too early or maybe not. As you said, like these things can extend. What are your personal thoughts of like the sort of current state of the markets?
The world got used to zero interest rates, negative real interest rates, which was a huge positive for any asset, equities and property especially. COVID, I mean, again, totally unparalleled. The only equivalent would be something like the Spanish flu in the aftermath of the First World War. But so nobody could see a global pandemic of that proportion with that impact on potential. I mean, the death toll was substantial, but the initial projections were substantially higher. So relatively, we got it later than we could have. but obviously the implications with lockdown for economics, for the economy, unparalleled. And that actually came as the world was sort of starting to get had been used to 10 years of negative real interest rates. Obviously the economy's collapsed, equity markets followed, and then the subsequent stimulus packages obviously took everything back to try and mitigate the effect of the pandemic on people's livelihoods, on the economy in general. And we've had a pickup in inflation on the back of substantial economic growth. Interest rates have gone up. And again, looking at historical cycles, when interest rates are going up, interest rates are going up for a reason. They're going up to try and rein in inflation, which is generated by typically economic growth. So the idea about short looking for a correction, well, why? Everything's growing. If everything's growing, why are you looking for a correction? You should be long. Is that going to end? Typically, again, looking at history, you'd say, well, when the Fed the Fed will start cutting interest rates at some stage. When the Fed are sort of into the second or third interest rate cut, then you think, actually, okay, why are they cutting interest rates? Because of economic slowdown, hitting corporate numbers, and that's maybe the time when we will be more into a deeper recession, a deeper correction. But at the moment, I mean, why fight the trend? The tape's going higher, so there's no point being short until it stops going up and starts going down. Like I said, it's easier to be short on the way down than it is on the way up.
Do you think the problem is everyone's too busy trying to predict?
Completely. I mean, I remember probably 9 months ago when everyone was saying the correction is around the corner. We'd had the correction after the pandemic. We'd had the economic bounce back because of the stimulus. Now everything's back to where kind of above where it had been prior to the pandemic. It was like, well, from what I understand, it's going down because it's gone up. Well, what does that mean? It could go a lot higher before it goes down. Yes, of course, we'll have a correction at some stage. We could even have a substantial bear market. I've got no idea right here, right now, and I think anybody who does, well, where'd you get that from? So, like I say, it's just because something's gone up doesn't mean it's going to come back down again tomorrow.
Definitely.
So being short is, well, why? It's like the same idea. It's like, so buying something because it's gone down. That's the problem about the bear market. You buy something because you think it's dropped too far.
Yeah.
Yeah, you might be right for a short-term bounce, but then when it makes new lows, what do?
It's so interesting.
Try and find the trend and just ride the trend as far as you can.
Do you think it's something to do with human nature? Do you think it's our nature
completely.
to try and be perfect or try and
completely
predict our projections onto the market?
My big boss when I joined Goldman was a guy called Eric Scheinberg. He was phenomenal, the greatest trader I've ever worked with. But he had one of his key stock phrases was, in the market, there's bulls, bears and pigs. Bulls think the market's going up, bears think the market's going down, pigs are the guys who want to buy the bottom and sell the top. It's impossible. It's impossible. Don't try and do it. You might get lucky now and again, but look for the trend and try and ride the trend. Don't try and call the end of it. It's a complete mugs game.
The reality of trading. Do you think the reality of trading isn't, home runs a lot of the time, like these big trades, big size trades consistently?
Depends on your style. Depends on your style. Some guys are better at looking for the home run. Some guys are happy to hit singles. Really depends on what your style is. I think it just takes time and experience to realize what you're good at, and then keep going with what you're good at.
We talked about your passion, and confidence, backing yourself. But what was the process like for you in terms of your trading? Was it something though you were passionate and confident with it, was it something still that you had to sort of develop and build your risk tolerance and your confidence and your strategy over time? Yeah,
I mean, first of all, as a professional trader, remember you're trading with somebody else's money. So everybody's trading retail money. They're trading with their own money. It's a lot more pressure to trade with your own money than it is trading somebody else's money. But the process is the thought process, the risk tolerance, the risk management, generation of ideas, all exactly the same. And that doesn't matter what size the account is or what your time frame is. It's again is what works for you and how you make money. That's something you've got to hone yourself.
Would you say that it helped? It was beneficial to actually be around other people who are handling large size, like large capital from the get-go, and therefore it makes it maybe, I don't want to say simpler or easier, but more so accepting it as a human being is like having an example, So let's say that an average retail trader, I go trade, I have no one around me who's trading millions or tens of millions or hundreds of millions or anything of that, anything close to that.
I think that's a good point because I think retail trading can be quite a lonely world because you are sitting in front of your screens or your phone or whatever it may be. Working on a trading desk, you got something to bounce ideas around. Am I missing something here? What am I not seeing? But in terms of the size, the most commonly asked question at Goldman was, are you big enough? Because if you generate this idea and you've got this track record, how big should we be? Are you big enough? And that's the question that everybody should ask themselves. If I've done the work and I really think this is a good idea, do I have enough risk involved in that idea? Because what's the point of doing the work? You're not going to make any money. Does that make sense?
That makes complete sense. No, complete sense. So as off the back of that, would you then, if you have this track record, you have this great idea and you're quite confident in this idea, let's say you felt that you weren't big enough, would you then go and approach someone to say, I need more size?
Yeah.
Or would you have to pitch the idea to them?
Yeah, but that's 30 seconds.
Yeah. It's interesting though, because I feel
we're not writing War and Peace here.
Because I find it interesting only simply because, as you say, you have the track record, you've done the work, right? And then it's about the size. And I feel like that seems to be the opposite mindset of the current traders, out there, the retail traders, partially maybe because they're alone and they don't know any better. Because I've been there myself. That's where a lot of the time when I speak like this, it's more so because I've done it. I don't have the stats of the whole market, but most of the time people are relating and they've been through the similar journey. But it's like most of the time I've found that they're focused on the size. They think the size is the problem. They think that because I don't have access to capital is why I'm not making money, or that's why I'm not a good trader. When they haven't got the track record, they haven't got the strategy, they haven't got the ideas to present for the size or to place onto any size, if that makes sense.
Well, ultimately, retail traders only trade their own money, so how much money you've got that's your constraint. But I would caution about trying to leverage that money too much because leverage can be very, very dangerous. I know some brokers out there are offering, in my terms, obscene amount of leverage. You get things wrong and you're too levered, it's game over. My guess is your guy who blew up the $1 million account, he was probably over levered. A good example from my past is long-term capital management, who went bust in 98, 99 on the back of the Southeast Asian crisis and then the ruble crisis. They were just way, way, way too leveraged. The ideas subsequently within 9 months were all very profitable, but in the short term they were just too leveraged and had no flexibility. The classic example of that in modern history would be the financial crisis, where I think it was 2002 or 2003, the SEC it changed the amount of leverage available for investment banks. Prior to that, they couldn't leverage 15 times, 15 times. Then the SEC took off the restriction. When Bear Stearns went bust, when Lehman went bust, when Merrill Lynch went bust, they were leveraged 40 to 50 times. So these are professionals who are getting it wrong because they are too leveraged. So yeah, going back to the retail trader, you only trade what you've got, and you should look at the percentage return. How much actual money it is, the percentages are important. Because obviously you get the methodology right, you get the process right, your percentage will grow, so your pot will grow, the size of your fund will grow, and then it's self-fulfilling. But the most important point is get the process right and get the risk management right. And that we got drilled into at Goldman, get the risk right and everything else will follow.
Definitely. Do you feel like time horizons is a big factor in that?
Oh yeah, completely. You've got to give everything time. I think looking for results too early, too quickly, or immediately, well, it's crazy. You've got to, just because you come up with an idea doesn't mean the market's going to think about it the same way today. And hopefully you're going to be right, but it's probably going to take some time to work out. So don't try and make money too short term.
And then equally as well, like the retail trader with their own smaller capital. As you say, focus on the percentages over time, that will play out.
Yeah.
What sort of time horizon would you suggest to the retail traders out there?
Let's take a break for a minute there, guys, because I want to tell you about the best trading tool on the market, TradeZeller. The reason why TradeZeller is the #1 trading tool that every trader needs is because you can do backtesting, automated journaling, trade replay, in-depth analytics, and so much more. And the greatest part about TradeZeller is that it's all automated. All you have to do is connect your MT4 and MT5. It will pull all your data onto the dashboard. You can add playbooks. You can just add notes. You can add images from your trades. and you can get the insights that is necessary for you to progress as a trader. Now, TradeZella is for absolutely everyone. Whether you're a crypto trader, whether you're a Forex trader, whether you trade prop firms, it is for absolutely everyone. And that is why thousands of traders have signed up using my link here through the podcast. Make sure you use the code RIZ10 for 10% off your monthly subscription, or WOR for 20% off your yearly subscription. The link is in the description below. And let's get back to the episode.
I mean, you've got to give things at least a few weeks or a few months. Whatever you think. I mean, ideally in trading, for the way I learned in my experience, realistically, you're looking for between 1 and 6 months. Anything shorter, you might get lucky, but you've got to give things time to play out. But also, you have to trading and investing are two different things. So looking for something in a 10-year view, I don't know. You tell me where we're going to be in 10 years' time. I mean, I can hopefully say we're going to be in 10 months' time, but 10 years, I mean, and also I think it was John Maynard Keynes who said, in the long run, we're all dead.
Yeah.
So, you make the difference between trading and investing.
What about in terms of...
Actually, just one thing about the retail traders is one of the key things to do as well. So I'm talking about giving yourself flexibility for your idea to work, but don't let a short-term idea become a long-term idea unless you intended that in the first place. So just because something hasn't worked, maybe you should be looking at something else. And I guarantee you'll get rid of something that subsequently will work. But remember that your trading portfolio, every single day, should be where your best ideas are right here, right now. If you've got something else which is more compelling, then just change your portfolio around. And over time and experience, hopefully you'll get things more right than you'll get wrong. But you've got to let your trading portfolio today has to be the most compelling ideas you've got. And if it's not, then change it.
And that 1 to 6 months is for the trade, the trade process and the trade playing out. In terms of the process of developing the skill set, though, developing that skill set to get to a point where you can say that you should be starting to show some sort of progress. As I mentioned to you, I believe just before we started, is like my mindset coming into trading. I was about 21 years old, roughly. I was like, 1 year. That's a long time. That's enough. I dedicated myself for 1 year.
That's fair enough.
What's your thought process from your experience through the Institute in particular? Because obviously you've experienced mentoring traders and seeing them as well. Like, what's the sort of average you've seen for those who are dedicated, putting in the work of what they should be thinking in terms of where they should start to see that progress form?
In the mentoring process, there was a very much a sort of commonality, a very sort of shared experience and a shared performance almost, that almost right from within the first 2 months, everybody started to make money. Then, typically the formal mentoring end after about 2 or 3, usually about 2 months. Then everybody would have a substantial drawdown. It was almost an element of getting too cocky. I've got this nailed. I don't need to have to do the work again. Get a bit of hubris, and then everybody get a bit of a bloody nose. So what we did, Anton and I, we sort of changed the process a little bit. So we would take it for 6 weeks, then have a 6-week break, and then revisit, because it was trying to almost protect people from their own hubris. Once you lose your humility and get hubristic, then you know for a fact something bad's going to happen.
That emotion.
So I would say you're looking at sort of 6 weeks, but realistically, you got to give it like 3 to 6 months. If you're not getting any returns by that stage, maybe you want to reevaluate how you're generating ideas or how your risk management is.
It's interesting to say that, because 3 to 6 months wouldn't necessarily be a long time.
No,
is that for like an absolute beginner, would you say?
Yeah, absolutely. Yeah, I think it's reasonable time. But that's 3 to 6 months after you've educated yourself, and you're not going to sit down with no education, no idea, and start making money. You might get lucky, yeah, cool. But your idea is to generate ideas, manage your risk on a consistently long-term basis. That takes time and experience.
And what markets would you guys focus on?
Equities.
Equities. Yeah.
As a retail trader, I think the US market gives you so many opportunities that wouldn't look elsewhere. The US equity market is by far and away the best retail market.
How do you find it? It was so interesting coming into trading for me, because it was just Forex. That was it. I just thought Forex currencies, And as time has gone on, I've learned about futures, options,
Yeah.
stocks, different markets from US equities to Europe to Asia, everything. And it's crazy to me in terms of the fact that there's so much opportunity, so many different avenues you can go to.
Oh, completely.
Definitely wouldn't make the mistake of trying all of them, right, and trying to dibble and dabble as a retail trader, especially in the beginning. But it's just, I find it fascinating. Even cryptocurrency now as well.
Yeah, absolutely. There's another one to look at. Yeah.
And it's crazy. What are your thoughts in terms of cryptocurrency, though? As someone who's been through this journey and seen all these different market cycles, here comes along cryptocurrency essentially out of nowhere.
Completely.
And has grown absolutely massively, had its own cycles in this time, and currently going through another one now.
Yep.
And what are your thoughts on that?
I must admit, I missed the whole crypto thing. I was aware very early on about some of the guys at the Institute were talking about crypto. I did a little bit of research. I didn't really quite understand. It was only Bitcoin. That was the only one that was sort of available, and that, I didn't really understand what it was.
Mm-hmm.
I was more intrigued by the sort of the blockchain technology which was behind
Yeah.
Bitcoin than the cryptocurrency. And I kid you not, I knew guys who had bought it at $100 and sold it at $500. So they made 5 times the money. But obviously, look where it'd be like, what, 65? Then I think then back down to 20, then up to like 75 or something. So yeah, completely okay. Whoop-de-doo, you made 5 times, but look at whatever. But anyway, he still made money.
Mm-hmm.
But yeah, so I and then there was the whole during lockdown where, in my opinion, because we had no sports betting, so many retail traders came into the crypto space, into the AM world, so even just generally equity markets and obviously Forex markets. And I think it was very much driven because there was no sports betting. So there was a bubble of sort of epic proportions. But obviously now we're back to and there were so many these internet currencies, which again, I mean, I'm sorry if anybody lost their money, but it's like, why would you even look at this stuff? What does it mean? What is it? How are you going to use it? What's it worth? It's worth literally what somebody will pay for it.
Mm-hmm.
So I just didn't feel comfortable with it. And to be honest with you, if I don't feel comfortable with it, then why would I get involved with it?
Yeah.
Because if you do any just a simple basis about trading, if you've got no conviction, you'll get shaken at the tree so easily. So you've got to have the idea with the conviction, and then you can take some risk. I didn't have that conviction or appetite for crypto, but a lot of guys did.
Yeah, definitely. No. How important do you think it is, kind of off the back of that? No doubt over your years, even at Goldman, maybe even, like you hear of something that sounds so intriguing or is being pitched as this next big thing, next great trade, whether it's long or short, either way, you're hearing all this. It's almost like an emotional talk, right? It's a sales pitch almost, when even if the person's not trying to sell it to you, they're just excited.
If something's too good, sounds too good to be true, it's too good to be true. Simple as that.
Is that something that you picked up along the way, or something that you've experienced the hard way?
I've experienced, not particularly the hard way, but I've seen situations and examples where that is definitely the case. Just if something's sounds too good to be true, it's probably too good to be true.
I find it fascinating because I think that a lot of traders fall for, and sometimes it's not even that it's too good to be true. It's like they give in to this impulse. It's as you said about FOMO earlier. It's like they give into this impulse of, oh, Bitcoin, everyone's talking about Bitcoin. What am I missing? Let me go over there. And yet they still haven't mastered their skill set in equities or commodities, but yet they'll jump.
I just think actually, I remember the sort of close to the peak of the Nasdaq bubble. The guy who was running Nasdaq trading in New York was a guy called Joe De La Rosa, and his way of saying it was, if everybody's bored, which way is the price going? It's down, because who's left to buy it? If you're, I'm not on social media, I know of influencers, but if somebody's telling you and everybody's buying it, are you going to be the last one to the party? I mean, yeah, but just think, if everybody's bought, the price is going down because there's nobody left to buy. So I just think you've got to have just be a little bit careful, because I do think my experience with the Institute and meeting so many retail traders, that the number of times I heard, I wish I'd come to you guys first. I wish I'd discovered you guys earlier before they're being scammed by some charlatans, or because there is so much bullshit out there in the retail world. And frankly, I find it obscene and disgusting. again, if something sounds too good to be true, it's probably too good to be true. So be very, very careful.
What was the motivation? Because obviously right now you're not part of the institute at this moment, right? But you spent a nice chunk of time really mentoring so many people.
And the reason why I left the institute is because an old colleague of mine asked me to, during the lockdown, when everybody could trade remotely, to work for a broker called Cantor Fitzgerald, trading UK AM stocks. So I did that. He needed a favour, and sort of I had to give up the institute for sort of compliance reasons. I couldn't get involved with any external businesses. Okay. I also stopped with I was also involved in venture capital funds in Newcastle, investing in the Northeast. Had to give up those for compliance reasons, which is fine. That was the right opportunity, the right thing to do. A friend needed help, so that's the reason why I left the institute. Otherwise, I would still be involved with it.
Of course, no. And what I was leading to, was more so like, did you ever think you would get into that sort of role, like teaching other traders, or?
Not at all. Absolutely not. No. Personal circumstances. My wife died of breast cancer in 2007, and we have 4 children. So I retired from the business full time to raise my family. I got involved with the institute because Anton had worked for me and with me for a few years at Goldman and asked me to get involved, and that's what I did. I enjoyed it. He asked me as a friend, and I was very, very impressed with what he had created, and also the quality of the people who we were meeting, the retail traders. There are some fantastic guys out there. Just need a bit of experience. That's what experience and education are. The 2 key things, and that's what the business was trying to do. And I think it's succeeded. Again, if you compare this to the 90-90-90 rule, we were looking at sort of probably somewhere between 10 and 20% would be down. Somewhere between 10 and 20% would absolutely knock the ball out of the park. But most guys, roughly about half of them, would be up between flat and up 20% on a rolling basis. Compared to the 90-90 rule, there you go. That's in black and white.
Definitely. And what would you say is important as a mentor? Like, what did you learn through that process of teaching others? Like, were there certain, as we already talked about in terms of like on average, people's learning curve, but like, were there any other similarities you noticed in that 10 to 20% mark, for example? Yeah,
there was a lot of similarities. A lot of the same mistakes were being made, but I think the most important thing is trust and communication. The retail trader's got to trust what we're talking about, and you've got to be able to communicate it. You've got to know your audience. You've got 3 guys; they'll respond to different conversations.
Yeah.
It's how you communicate it, and ultimately you've got to have the right ideas.
Definitely. And I'm sorry to hear about your wife's passing. I'm sure that was a very difficult period, no doubt, and especially leaving your career as well at the time. In terms of trading, though, those sort of things, and this is what I've noticed from traders, is at the end of the day we talk about our emotions and being dialed in and sort of confident on the markets, for example. But when situations outside of trading happen, whether it's as extreme as that, or even something as simple as arguing with a partner or sleeping bad, for example, these things, I think a lot of retail traders don't have that understanding of that. These things really impact their trading.
Oh, completely.
They're not prepared for the trading.
If you're in a bad situation or you're ill or whatever it may be, I've always found the best, and whatever the reason may be, if you're not seeing things or you're not analysing things correctly, it doesn't matter what you're doing, just scale it down, just have a break, get 0, play 0, have no positions, walk away, do something else, clear your head, and come back to it when you're ready. You don't have to be trading all the time. You remember, as a retail trader, you're managing your own money. You're not managing somebody else's money. You don't have to. If you're a hedge fund, you pretty much got to be fully invested at all times. Otherwise, you get the question, "What are you doing with my money? Why am I giving it to you? If I can put it in the bank. If you're not going to trade it for me." As a retail trader, you got the flexibility that you can be 0, play 0. So you want to go and book a holiday or focus on whatever you may be, just take it down to 0, play 0. You can always come back to it. So that's a flexibility which I think retail traders don't really appreciate that they've got. And I would keenly stress that, because it doesn't matter how good you are or how bad you are, or everybody will have bad runs. That's just life. It's impossible to be consistently every single opportunity come your way and you maximize it. It doesn't happen. Sometimes you're not seeing it clearly for whatever reason. Then just scale it down and have a break. That's a flexibility that I think retail traders really need to take on board.
Definitely. I think I've seen traders. I've seen it so often. I was that trader at one point, as always. But there's so, you could call it passion, but maybe it's addiction. I'm not sure. But it's like,
I think passion and addiction can be very, very fine lines.
Close, yeah. And it would be literally market open. Forex market opens 10 p.m. UK time on a Sunday. Market opens, trading the gaps, trying to trade straight away, try and be active in the market straight away. And don't get me wrong, someone might have an edge with that, right? If they have an edge with it, cool, right? But the reality of people who are doing that really don't. And I especially didn't. I remember I was like, the market. Maybe a couple of weekends I watched it and I saw that the market filled the gaps that were created over the weekend. I was like, this is easy. This is easy. I can just trade that gap. And it might have worked 1-2 weekends, and then the third weekend I remember that gap didn't get filled. It was on GBP, NZD, the New Zealand dollar, and that gap didn't get filled for 18 months.
There you go.
And I was obviously wiped out within 2 days. So that was a valuable lesson. You know?
This is again going back to is everybody's looking for a correction, etc., etc., etc. But if something gaps up or gaps down, it's doing it for a reason. Mm-hmm. And if you're looking to fill the gap, like I say, 18 months later, fill the gap. Okay, whoop-de-doo. But if it's going to, in my experience, if something gaps, it's going to continue in the direction of the gap rather than fill the gap.
Yeah, it makes sense. I'm pretty sure in terms of the market movements, we have like fundamentals, for example, and sometimes we have the fundamental releases, but the markets don't initially react, right? Even though don't get me wrong, I think a lot of retail traders unfortunately don't learn fundamentals. I'm being one of them. I've really picked it up, started more recently because of thanks to the podcast, really, because of conversations I've had with people like yourself or just purely fundamental traders. It really opened my eyes to why aren't you learning fundamentals? Even if you trade technicals, right? Even if you do trade technicals, why wouldn't you learn fundamentals?
I don't think you can trade without knowing the fundamentals. Like I say, technicals for me are just time entries and maybe look for where I'll be thinking about sort of taking profits. As a simple thing, if something massively overbought and looking very stretched, probably don't want to initiate a long right here right now. If I'm looking to get short, then obviously I'm just waiting for it to turn and I'll get short. But you need the fundamentals. Technical analysis, I mean, it's self-fulfilling. You draw lines on a chart, you see what you want to see.
Do you feel like the technical side, like the charts, are they just a reflection of the emotions that are happening, the reflection of essentially the buying, the selling, the volatility? It's the reflection of all those buyers and sellers, and therefore
that's the price. But it's telling you what's happened. It's not going to tell you what's going to happen.
So do you feel like technical analysis trying to paint the story of, say, for whatever trend line or Fibonacci sequence or etc. that and people trying to depict from purely technicals, do you think there's not really an edge in that, or have you met technical traders who have done that?
No, I haven't. It just doesn't make any logical sense to me. So I would discount it. You need the fundamentals. If it was so easy to look on a chart, then you do it for a couple of weeks and go to the Bahamas, buy an island or something. It's not that simple, unfortunately.
In terms of the fundamentals, as I was trying to get to, was like when we see news releases.
But why doesn't something react? Well, you have to remember that any asset class, so my world is equities, but equities are typically anywhere between 1 to 3 months ahead of the actual economy. So they're by definition, they're a leading indicator. So if you're expecting good news and the stock doesn't go up, it tells you it's already in the market. Everybody expects this. If you're long, it's probably time to get out. Conversely, if you get bad news and something doesn't go down, well, it's like, it's already in the market. The market's looking forward.
So when they say it's priced in, is that?
Yeah, the priced in. So all asset classes are a leading indicator. They don't tell you where the world is today. They tell you where it is somewhere between 1 or 3 months into the future. That's why sometimes when you get press releases or information, the stock price doesn't react or the currency doesn't move because it's already expected.
So similar like with the interest rate decisions.
And that can be a very powerful data point. Like I said, if you're long and it doesn't rally on good news, you probably want to get out. Or if you're short and it doesn't go down on bad news, you probably want to cover it because the market's telling you it's already looking forward.
because we do see that often. To be fair,
Yeah,
we see
yeah,
it quite
yeah.
often, and we see it. We see the reaction of traders quite often as well in terms of being confused because of the lack of fundamentals. A lot of people, they look at Forex Factory, for example, as a website, and they see the prediction was meant to be, let's say, 100,000 jobs, unemployment claims, and yet it comes out essentially worse, so 120,000, let's say, come out, but yet the market doesn't move, and they're like, but it's gone higher than predicted, right? And that's all they're looking at, just that figure, without the actual understanding. I've been there, like I said, without the understanding of actually what this represents.
Well, you've got to, again, this is where you need to, because looking at employment data, is 20,000 significant? Are there any revisions to previous numbers? It's not just the headline number.
Mm-hmm.
So that's, again, where you need to have some sort of fundamental analysis, some fundamental understanding. So the 100,000, what's the range?
Mm-hmm.
Is everybody, give or take, 10,000, 20,000, or is it 0 to like 500,000? I mean, is this a weighted average? I mean, you got to do a little bit of digging.
Mm-hmm.
You can't. It's not that easy.
To be fair, a good example is COVID times. I remember the US obviously had crazy numbers coming out during COVID.
Yeah.
The first one, yes, had a good reaction, of course, as you can imagine, because we didn't know where the scale would be.
Yeah.
But as you said, the range, right? But then as soon as the second one come out, the range has already been formed now.
Mm-hmm.
So it wasn't as much of a shock to then see these very high numbers, and then subsequently the third, the fourth, and as it starts to decline and so on. So it's a very good example there, actually, to be fair. Talking of which, though, I had an interesting moment. I would love to hear your feedback, because you've been through different market cycles, and no doubt you've traded. I would imagine during your time you had certain events that would have happened in the markets too. So meet COVID, for example, and with that exact example of the huge job unemployment claims. I remember I was in one of these Discord, Telegram chats, and the news number come out, and I was like, whoa, that's such a crazy number. And I was in a particular trade, and I was like, wow, that's amazing. That's what I said, something like that. I think I put amazing, or look at this number, lol, LOL, laugh out loud. And then someone kind of called me out on it and was like, yeah, it's not very funny. 2 million people lost their jobs. And I was like, yes, I didn't really think about the consequences of this number. I was just thinking trading wise, wow, I've got into a trade and it's done some great numbers. And I maybe just kind of reflect for a moment. I didn't really take it too deeply on board, but it was more so like maybe in talking about it, regardless of whether it's in a trading chat room or not, got to be a bit more sensitive, because of course it is impacting people's lives.
Yeah, I hear you. I completely see what you're saying there. I would say that the real world, too many people losing their jobs, and the actual currency market, trading the US dollar, two different things. Two different things. The asset classes, the US dollar against whatever currency you're trading it against, that is a market. It's a human construct, but it's not human. The market doesn't care if you're long or short. Doesn't love you, doesn't judge you, doesn't hate you, doesn't do anything at all. It's nothing personal to you, and you should not be emotionally involved with it. For the 2 million people who lost their jobs, that's a whole different dynamic. They're two completely different things. So you're talking about the US dollar currency. The people losing their jobs, yeah, that's a tragedy, but they're two different things. You're not saying, great, people have lost their jobs, which that's whatever your viewpoint is. But I think it's two very, very different things. I sympathise with why you would say, look at that number, LOL, because you're looking at the dollar market. You're not, the people actually, the two completely different things.
Yeah.
Completely different things.
And
also don't confuse them, because I think this is, again, the emotional involvement, the emotional attachment to positions, to markets, is that the market doesn't couldn't care less about you, couldn't give a shit. Why would you think, the market's moving against me, whatever? It's like, this is paranoia, this is conspiracy theories, whatever it may be. The market doesn't care less about you, anybody. The market is the market. The price is the price. Do you want to buy it, or do you want to sell it, or do you want to do nothing? That's all it is. So don't confuse that with the real world and real emotions.
Definitely. Have you had any of those moments in your time?
Right at the start, but you got to control it, and that is the market couldn't care less about you.
For me personally, I was the same. I had the same mindset. I've treated it more like this is the job that we've prescribed to do, and therefore that's what we're meant to do, and we're meant to react in that way. And as you said there, it was very interesting, which is more if you introduce that emotional component, even if it's the right thing to do or a good way to think or to at least observe, it can be very dangerous to your trading.
Completely. Don't confuse the real world with trading. They're two completely different things.
What are your thoughts in terms of trading psychology, trading mindset? What is the necessary mindset to bring to trading?
It's kind of so many paradoxes that it's almost you've got to be humble, but you've got to be confident. Well, how can you be? You have to know your limitations. You have to know your strengths. You have to know, like you say, you've got to be confident to back your ideas and generate ideas, but also you've got to be humble to realize when they're not working. And if whatever your stop loss is, then you get triggered on your stop loss, boom, out, forget about it. You get rid of the position, move on. If one thing that I learned through bitter experience is if you don't feel comfortable in a position, it's for a reason. Get rid of it. Back yourself, back your experience, back your judgment. But if you ever feel uncomfortable, get rid of your position. So yeah, you've got to be humble, but you've got to be aggressive and confident, which again is a bit of a paradox.
I think that's why it's a struggle for most traders, do you think?
Yes, I think that's why you're trying to reconcile your thought process with what you see on the price action. They're not necessarily the same. You may not be in the same wavelength. So yes, I think there is that's why traders can struggle, because to be honest, as a trader, I think it's what I learned very, very early on and very quickly is it's relatively easy to make money. Anybody can get lucky. How you learn about trading is how you deal with losses, because, like I mentioned, stop losses, but stop losses are essential because it's the old line which we said a million times: you can lose the battle, but you should never lose the war. Your friend who lost $1 million currency account, he would put himself in a position to lose the war. You should never do that. So stop losses are absolutely key. But also by key, what also is key about stop losses is that if you get triggered and you cut your position, so you cut the position, you've got to be disciplined, because over my career I've had so many losing trades, it's ridiculous. But I've never been in a position to blow up. So you've got to learn how to take your losses and then move on. But don't lose sight of the generation of ideas, because the idea might have been bad, or for whatever reason, or your timing might have been bad for whatever reason, doesn't necessarily mean that you can't then subsequently come on to generate a winning idea, a good trade. But I always find it's nice if you get stopped out, have a little break, just sort of clear your head. Don't leap back in, because if you try and do a trade straight away without the proper analysis, without the proper thought process, guaranteed you're going to do money. You're going to lose money, guaranteed.
Do you feel like what you mentioned there, in terms of have the small break, but do you feel like in terms of the stopping the generation of ideas?
This way, that's why you can't lose your confidence.
Yeah. Because I was going to say, like a lot of people I've found, and I did this in my journey, especially in those first 3 years of trading, is I would take 3 months off. You know, after a blow up.
Yeah, that's cool. Whatever works for you. Again, it's whatever works for you. Whatever your personal.
I would take it off completely, right?
That's
so
cool.
Therefore, I'm not generating ideas. And what I was trying to get at, though, is do you think, yes, it can be beneficial for some, but overall, in terms of the trader's growth, the trader's consistency, longevity, do you think that's, obviously, I've done that because I've blown up there. But some traders do it when they've taken some losses, right? A large period of time gone. And I feel like, essentially, especially in the early days, as you're still trying to formulate your plan and formulate yourself as a trader, I think it can be quite dangerous to do that, because I think it prolongs your learning experience.
I'd say 3 months seems a bit excessive. I would say maybe a week, 2 weeks. 3 months seems a little bit excessive, because you got to get back on the horse.
Exactly.
But the same token,
because I feel like that becomes a cycle.
Yeah, it's whenever you feel that your thought process is rational and you're ready to engage in a professional, correct manner. I would say 3 months is probably too long, but I'd say I'm trying to avoid you thinking that the market owes you money because you lost money.
Mm-hmm.
It doesn't work like that. Like I said, if you try and put a trade on straight away without the proper analysis, guarantee you can lose money,
100%.
and then you're going to get more annoyed.
Yeah.
You're going to get more frustrated,
Mm-hmm.
and then it's going to take you longer to come out of it.
Definitely, no. Because what I was trying to get at was just the cycle of that,
Yes,
right? Like
yeah.
you go in, you might make some money, lose some money, but then you end up losing overall. You then take this 3-month period off where you're not generating any ideas or even watching the market, for example. You start from day one again, do the exact same thing. You make a little bit of money, lose money, 3 months off again, and you prolong the journey. So that's why it's interesting when you said about the 3 to 6 months, to be fair, of a trader sort of learning, going through that learning period and starting to show some signs of progress within their journey. Because when you break it down, like a trader who, like myself, let's take that 3 years I talked about before I started seeing progress. Of the 3 years, how much was I actually observing and watching the markets, right? Because of all those breaks, and the first year I really didn't do too much at all. So then those subsequent 2 years, there were loads of those break periods. So then you take all that out, the actual time in the market then probably boils down to more 6, 9, 12 months period.
So it's probably less than you think.
Yeah, and I think that a lot of traders are like that. And I think even traders who've been trading they say they've been trading for 8 years, let's say. But the reality of that 8 years is very sketchy, very... lots of gaps in there, loads of it.
So you actually condense it into actually how much time have you actually spent trading?
Mm-hmm.
Like you say, maybe
Because when you're talking about the institute, then
I'm talking about this is intensive. So this is right from the
that's
get-go.
what I was gonna say. Yeah.
There's
So
no
like,
breaks.
what does that period of time look like? What are they doing?
They're working.
Mm-hmm.
I mean, most people have a regular sort of job, and this is the trading on top of it, which is not, especially learning the process how to generate ideas, it can be very, very time consuming. But once you've learned it and once you get comfortable with it, then you start applying it.
Mm-hmm.
It's not such a bad thing to have other distractions, because what you don't want as a trader is to be sitting in front of a screen all day watching tick by tick, because it'll make you trade badly.
Yeah.
It'll make you take profits too early, and then it'll make you run losses for longer than you should do. So one of the things as a retail trader I would try and encourage is don't sit in front of the screen all day. It will make you trade badly.
How important do you feel it is to have things outside of trading?
Oh, absolutely essential. Essentially, everybody's got to have a normal life. You've got to have other interests, whatever they may be. I don't care, but you've got to have other interests. You've got to have other things which you've got passion for. Whatever it is, that's down to your individual choice. But I think sitting in front of a screen all day, it's not particularly healthy. I think doing anything all day is probably not particularly healthy. So you got to mix things up a little bit, haven't you?
Definitely. In terms of even now, like your personal trading, but also the professional sort of career that you've had as well, was there much focus on, say, like R multiples, like how much your risk to your reward?
Yeah, completely. Yeah, absolutely. Where the numbers, the R multiple, the Sharpe ratio, etc. There was a focus on sort of trying to get you as strong as possible.
Mm-hmm.
And again, it's experience and education.
Mm-hmm. Was there any sort of like minimum that you would have to, sort of threshold before a trade becomes acceptable to you?
No, not really. Not really. I think you need to have a process, but you need to have flexibility within that process as well.
Mm-hmm.
And ultimately, it's always easier not to trade than it is to trade.
Mm-hmm.
So if you've got any concerns, anything you're not sure about, look for something else. Mm-hmm. There's always going to be something else out there. So I would, unless you got 100% conviction, don't do it. And when nothing's going on, do nothing. My old boss at Goldman, Gary Williams, one of his lines was just he'd sit at the desk and put his hands under his knees. Just sit in your hands, do nothing. Because you try and make some money when there's nothing going on, guaranteed you're going to lose money. So you got to know when to engage and when not to. Mm-hmm. Because market cycles, market times, even during the 12 months of the year, there's different opportunities, different times, and things are moving differently. So when there's nothing going on, do nothing.
In terms of risk, what are your thoughts on terms of risk? Because a lot in the retail space, there's a lot of, I think there is a misconception slightly. Because when I look at professional traders and highly successful traders, even from the past and to present day, the ones who have really made good returns, of course, they've gone through the period of learning and getting their experience, learning to understand their intuition, etc. And at a certain point, they're able to then be very dynamic with their risk, meaning that, yes, they'll have their singles, as we talked about earlier, but when it comes to home run trade and their analysis tells them this is, from my experience, etc., this is a home run, time to size up. And that's where they make the bulk of their career's profits from those sort of trades.
Completely.
While with the retail side, it's very much a thing of like 0.5% risk, 1% risk. Stay in that window and that's it. That's professional trading.
No, you need to size your positions according to your conviction and how they are working. So if you've got full conviction on a trade that's working, it should be at least 100% of your allocated position size. It can be bigger. If something's not working, I don't like having full positions until things are starting to work.
Mm-hmm.
So I don't average down into positions, but I want to have a full position which is actually working. So the most important thing is when trades are working, look to increase them.
Mm-hmm. So when you say full allocation size there, I just want to...
Oh yeah, so say you're looking at, say you want to have 10 positions
mm-hmm.
of 10% of your portfolio each,
mm-hmm.
but you can have sort of some, it doesn't all have to be 10%. You can sort of have 20% or 5%. You can different sizes,
yeah.
But it just is a sort of a rule of thumb. This is where you want to be invested.
Mm-hmm.
But when trades are working, that's when you should be full size.
Definitely.
Don't be full size until things are starting to work.
Yeah, so the opposite of what a lot of retail traders is, they'll average into the losing trades, right?
You can average into zero. So I don't have a full position until it's starting to work. And if that means you're buying something higher than it was a couple of days ago, well, whoop-de-doo. The world's changed. What you thought was going to happen is now starting to happen. This is when you should get full size. This is when you should take the maximum amount of risk relative to your portfolio.
I've heard someone speak previously in the past about edge within markets. And their opinion was that the Forex market doesn't have any edge. The futures and options markets don't really have much edge. For them, it was in the penny stocks, in the US penny stocks.
Well, it depends on what you're looking for and how you define edge. I'm guessing the edge would be something along the lines of scalping or day trading.
Mm-hmm.
Yeah, I mean, how are you going to scalp the dollar against the euro? Any opportunities are going to be algoed out. And where's your value added? Well, what do you know that the market doesn't know? So I think looking for edge is just a fool's errand.
Do you feel like, in terms of, because for example, CFDs and the Forex market,
yeah.
There's a lot of traders doing that, scalping and day trading. Whether they do it successfully or not is depends on them, I guess. I've known some. I have known one or two who done very well from scalping, or more so day trading currencies, and they've done so very well. And I find it interesting. Do you think that, from experience, is it the size, when you can get sized out of these sort of sectors like scalping and day trading because of the size that's being traded, or even the small size you think can't really be trading successfully?
I mean, I've never day traded currencies, so I don't know. But I'm guessing your currency, your size in the currency market is not going to be a problem. I mean, what currency market turns over $2 trillion a day? Mm-hmm. I don't think it's $2 trillion of retail trading money out there.
Yes, I think the currency market has now gone up to like 7 trillion a day now.
Well, there you go. That's
there's definitely no in there. Do you think the leverage?
Leverage, like I stressed earlier, leverage is very, very, very careful with leverage. Mm-hmm. Really, you want to take, from an equity world, let's say you probably want to start off no more than 2 times until you start actually getting some track record, and then maybe take it up to 3 or 4, but that's it. And obviously you've got to adjust your stop losses accordingly. But in the equity world, my world, anything which is north of that is just absolutely nuts. That's how you blow up. That's how people blow up. And ultimately, what we want is, we don't want retail traders to blow up. We want them to, this is all about long-term wealth generation. If you've blown up, then you're not going to generate wealth long-term. It's that simple. So I'd be very, very careful about taking too much leverage. And like I say, in the equity world, start off at 2, maybe get up to 3, 4, 5 if everything is really going well, but that's it. I know in the Forex market you can have like 50, 100 times leverage, can't you?
Yeah, 500 leverage. I heard of one recently, 1,000 leverage.
I mean, that's just nuts. That is just, personally, I think that should be illegal.
Well, the thing is, it's not allowed here. It's not allowed in the UK. It used to be, and then they changed the rules 6 years ago-ish.
Okay.
Then people would just go to like Australia to get the 1 to 500. Now, even they had new rules come in. Or they'll go to European, then they've changed, then to Australia. Now they've had rules come in. So now those same entities are set up in other jurisdictions that can then allow the leverage. So it's basically just
there's always a way around it, isn't it? You know?
Yeah.
I mean, it's basically if there's an appetite for that kind of leverage, then somebody's going to find a way to provide it.
Yeah.
And if the UK have clamped down, that's because the UK probably don't want egg on their faces when a whole lot of retail traders brought up.
Yeah.
I would just, to honestly, I don't care about the regulations. I don't care about where you're located or what your jurisdiction is. What I care about is people taking undue leverage, which is going to blow themselves up.
Yeah.
That's the most important thing. Be very, very careful about it.
Definitely. What are your thoughts in terms of trading-wise capital? In the sense that, just off the back of that topic, the reason why a lot of people really try and go after this leverage is because they're trading such small size. Like they think, I have £500, I need to get 1 to 500 leverage to make money from this.
Yeah, I understand that. Well, then I would say focus on generating more capital.
Yeah.
Don't do it until you've got enough that you can make decent returns, a decent amount of money with a 5, 10, 20% return. So just focus on growing your capital. It's like whoop-de-doo, that's easy. No, it's not. I appreciate it's very difficult, but I would say keep your powder dry until you're ready to do it properly. Yeah. Because if you start 500 quid on a 500 leverage, well, just go to a casino. Yeah. You may as well play blackjack or play roulette or whatever you want to do. Because where's your edge? Where's your the fundamental analysis? Where's your idea generation? It's not. Focus on growing your pool to start off with, and then focus on doing it properly.
Because that's the exact question basically I was going to get onto is like, what are your thoughts in terms of people trading without capital, like with no strong sense of capital or foundation? I always try and tell people that you should really have your savings down properly, because otherwise you're always trading from desperation and the need for money. And even though yes, we trade for money, we trade because we do want to make money, of course. Like we're not going to pretend like that doesn't exist. But at the end of the day, if you don't have any to begin with, and you're just putting any little amounts you have, the desperation and need for it is always going to overdo the skill set and the necessary mindset.
Well, just think about it. You've just said if you're trading out of desperation because you need to make money, then are you going to be able to think clearly? The most important thing about trading, as most everything else in life, is you need the ability to think clearly, rationally, and to take the appropriate actions. If you're acting out of desperation, you're not going to be thinking clearly. You won't be taking rational decisions. You're not, like I say, if you want to have a punt, go to a casino. It's madness. It's just crazy. Or think another way, you're just putting your money in somebody else's pocket. Why would you do that? It's nuts.
Because that's the reality of it. Do you feel like there's a huge sort of mindset shift because most people are just trading on their phone? They see these numbers on a digital screen, and they kind of just really desensitize themselves to that money.
Yeah, you're talking about a fruit machine there.
Yeah,
that's what it is. Yeah, so well, if that's what people want to do, that's fine. But I've got no value added to be like that, because of whatever my experience and whatever I'm trying to sort of pass on the benefits of my education and experience, then it's wasted. I mean, so I wouldn't call that trading.
Yeah, I think that's very fair. And it's like we said earlier, it's like the passion and the addiction. There's a fine line there, and then that's where it starts to fall over to the gambling side. Well,
I think that it comes over to the addiction side, and I think it's. I don't think you shouldn't go into trading purely to make money. You should go into trading because it's interesting. It's compelling that your analysis and you're taking risk, but the most important and what I find the most fulfilling thing about trading is the idea generation and then seeing the success of those ideas. Yeah. The money that follows is kind of, it's nice, it's a byproduct, but it's not the reason to do it. Yeah. Like I said at Goldman, the most important thing was get the risk right, and then the profits will follow. But you've got to focus on getting the risk right, and that's the interesting part.
What do you think that is? Because we've talked a lot about different topics there, but a lot of it does fall back to build your experience, get your ideas, risk right, as you said. What would be your sort of thought process of people doing that, learning to build their experience, learning to listen to themselves and that sort of intuition?
Well, I must admit, I would highly recommend the Institute of Trading Portfolio Management, because this is very much aimed at retail traders who want to do it like professionals, have got some money together, and want to develop a process and a logical rationale of how they take risk, why they take risk, and generate long-term wealth generation. I think unless you've got some experience, I mean, why would you expect that you can trade? I mean, you want to do anything correctly, you've got to study it, you've got to learn from professionals, and you want to take on board the appropriate lessons and then tune it to how it works for you. I think you'd be kind of crazy to think I can just open an account at whatever and sit in front of a screen, hit a few buttons, and then suddenly I'm whatever X amount of dollars richer. It doesn't work like that. You've got to put the effort in, and you've got to learn from people who have done this as a profession and have done it with experience and have been correctly educated.
Definitely. As you say, in terms of education, a good student ends up being the one who gets the results in the end, right? Mm-hmm. A good student.
Yeah.
From your experience, what traits or what habits did that good student have?
Exactly the same traits as somebody who's getting interviewed at Goldman Sachs. It's intelligence, ambition, it's enthusiasm. It's exactly the same. It doesn't matter. I mean, we're talking about trading, but it could be talking about anything, and any interest, or any passion, anything you want to get involved with. Having been intelligent about it, being enthusiastic and willing to do the hard work, it's not kind of, you're already halfway there.
In terms of the hard work side, just to sort of break that down a little, are they the traders who are collecting their data, making sure to track their trades, consistently breaking down their ideas? Would you even say, though, consistently turning up to, let's say, for example, if you guys are hosting a webinar, they're consistently there at the webinar or watching it? Or let's say, you have let's say they're consistently asking you a question, or any of the other mentors, consistent, high-quality questions. The reason I'm asking this is simply because I'm trying to really get a sense of, for the audience who may be still going through that learning process, of how they can become a better student, if that makes sense, whichever endeavor they're in.
The intelligence, enthusiasm, and the ability to work hard, or the desire to work hard. And again, work hard and work smart. You don't have to put all the hours in, but as long as you're doing it efficiently, you talk about your sort of experience of taking time out of the markets collectively. How much actual time do you spend trading? Less than you think. So you've got to put the hours in, you've got to put the time in, but make sure you're doing it effectively.
Off the back of that, though, one question that's kind of been in my mind this whole time, and I'd be really fascinated to hear your answer, is: do you think anyone can be a trader?
Yeah.
Anyone at all?
Definitely. But like I said, I think you've got to find a style and a way that works for you and brings out the best of your attributes. We could have completely different trading styles, could both be as profitable as each other. Doesn't make any difference. And it's very much a personal thing. So don't compare yourself to anybody else. Most of it's going to be bullshit, but it's a personal thing. Yeah, but anybody can be a trader. Anybody can take a risk. Anybody can. Some people probably are not as risk appreciative or more risk averse than others, and that's fine. You don't have to take risk. You less chance of blowing up, probably less chance of making healthy returns. But that's, again, it's whatever works for you. It's very much a personal thing, and don't try and mimic. Learn, but don't try and mimic.
What do you think the reality is of what people see online now? Because I know you said you're not on social media.
Yes, I've got no idea, really.
But on social media, there's two elements. There are those who have done the work and are consistently profitable. There's a minute number of those, but they do exist. I know a few, but they do exist. And they teach and they educate, and they show a reality of trading though. They share the ups and the downs, the hardship, and that it's not going to be an easy ride. Equally though, on the other side, we have a large majority that are showing a particular lifestyle to promote of trading. And the interesting thing about that, though, is then obviously the retail traders doing that, of course, and then they're showing this lifestyle. They're showing it's a bit easier than it is, and unfortunately nowadays there's a huge number of influencers who aren't even actual traders. They're just promoting signals, and because they have broker affiliations.
Oh yeah, there's the whole thing about a lot of the Casatawi got
Yes,
done for some of this recently. I was reading about it.
There's a lot of it now.
I would say if somebody's portraying a lifestyle, be very take it with a huge grain of salt. I'm not saying it's not going to be true, but we've talked about trading. We talked about the application, the interest, the passion about taking risks, generating ideas. That is trading. The byproduct, yes, if you're successful, you'll make some money, but then use it to trade and make more money. Whatever this whole on social media and portraying a lifestyle, I would say the lifestyle, that's if you want it, but you've got to do the process to get it if these lifestyles are actually accurate and true. So again, if something sounds too good to be true, it's probably too good to be true.
Goes back to that.
But focus on the process and the actual enjoyment and the generation of ideas and taking risk, rather than, like I say, the byproduct is the money. But that's not the reason to do it.
Do you think that's that human nature thing again? that we discussed? Like people see it and they're like, oh.
Everybody wants something for nothing. Everybody wants to be get rich quick. Nobody wants to put the work in. Life doesn't work like that. If something's worth working towards, it's because it's worth it, and that's how you get the rewards. So, like I say, if you human nature wants to get there tomorrow, not next year.
Yeah, that's very true. Let alone 5 years or 10 years.
Exactly.
In terms of, I want to touch on the subject, and it's completely up to you if you want to go into it. And the reason I do it, though, is because increasingly, especially nowadays, we're seeing people who struggle with handling loss, not in trading, outside of trading, and having to go through, unfortunately, either themselves or family members who go through cancer, and the struggle of that. And we don't have to touch on it, of course. It's completely up to you.
Yeah, no.
The reason I asked you is because you went through it, obviously, and you had to then retire and then look after your family. And that's a huge thing. And my mum had to do, we lost my dad when I was 5, not to cancer, but to a different circumstance. But my mum had to give everything to us 3 kids. And it's a very similar situation where you've had to go through as well. And I think a lot of people out there, unfortunately, don't get to hear other people's stories, right? And they do suffer alone. And it's something that rightly you will suffer through, but they don't get to hear how other people have gone through that or handled that, or and what their thought process was through that period. So I'd love to give you that opportunity if you were willing to sort of go through that with us.
To make it simple, it was fucking awful. And my wife died when she was 39. Our kids were 7, 5, and the twins were 3. So boy, girl, and boy, girl twins. Wow. That was 17 years ago. And it's incredibly difficult raising a family by yourself. And yes, I've got a partner, but it's different to their mother by definition. And your mother being in a similar position with 3 young children, it's incredibly tough. It's tough emotionally. It's tough even logistically, because I had been a trader in the city for 14 years when my wife died. I didn't know how to use a washing machine. I didn't know the dishwasher worked. Stupid things like that. But yeah, it's like I got to learn. I've got to cook for my kids every night. I've got to literally be at a football practice and a netball practice in 2 different parts of the town at the same time. The logistics are incredible. And in the right male press, the single mothers of this country have always been vilified as leeches and social security scroungers and staying on society or whatever. These are the people who have generated the problems why the perceived danger, the perceived weakness of the country or whatever it may be. It's like you try and walk in their shoes. That's I was fortunate I was in a financially secure position, but without that, I would have been to be working full time, taking the kids to school, picking them up at night, doing all the homework and the the usual sort of logistics of feeding them, washing them, cleaning them, getting them ready for school next morning, etc., etc. And I didn't have to work full time. I think if you do that and work full time, I mean, that must be impossible. Impossible. So, like I say, to a single mother like yours, you try walk in her shoes and see how easy that is. But what saved me was my children, because regardless of how bad I felt, they needed to get up to go to school in the morning. They needed to have a clean pair of pants, a clean pair of socks. They needed help with their homework. They needed to be fed. So that's what stopped me from sort of just spiraling out of control, really. And I'm sure your mother felt the same.
Yeah.
That however bad she felt, she still had her children to take care of. But life goes on. I mean, your life has to go on, because otherwise you're lost. But I think that's, with hindsight, that's very easy to look back and say and see that. But at the time, it doesn't feel that easy. It's very difficult. And it's my wife who died. I mean, she didn't want to die. That was the last thing. You know what I mean? You know what I mean? It's like, anybody says, like, pity me. It's like, fuck you. She's the one who died. Your dad's the one who died. So that's the tragedy.
Yeah, definitely. And I think, would you say, as you said there, you were a trader in the city and didn't know these other skills, right? Nope. Do you feel like, and I've sensed it myself, just going through not only the trading journey, I think entrepreneurs go through it. I think people on a particular mission, they kind of get stuck on it, especially in this day and age where everything's about success, financial freedom, push it. And nothing wrong with that necessarily, but in those moments, we realize that actually how important it's good, because as you said, like, you were luckily in a position then to be in a financially stable position to be able to then a bit easier to be home.
Completely. I was in an incredibly fortunate situation that I didn't have the pressure to raise money to support my family.
Would you say we get lost in that world of finance and money and success?
100%.
Sometimes we neglect some other things such as skill sets at home.
Completely. This is when I'm talked before about having passions and interests outside of trading. Obviously, your love life, your relationship. I mean, that's the key one. I think you've got to, but everybody's got different priorities. But having one overriding one is probably not particularly healthy, and for me, would not be the route to happiness. But everybody's cut differently, so what turns you on might not turn me on, and vice versa. But I think trying to find something that you enjoy, love, and that's the source to, I'd say, happiness. That's I think we kind of lose sight of that, because the old line at Goldman, who's the happiest guy in the world, is the guy sitting on the Goldman trading desk who got paid $1 million bonus.
Yeah.
Who's the most pissed off guy in the world? Same guy, when he found the guy sitting next to him, got paid $2 million. So be careful about financial success.
Yeah, definitely.
It's not bad, but there can be other things.
Well, it never ends, doesn't it?
Well,
that's,
exactly.
That's something I've learned as well. It's like same with social media. Like social media, it's the same principle. You're happy at 10,000 followers. You're happy at 100,000. But it doesn't. The numbers don't end. They just keep going. You know.
Exactly.
Same with finances. That's what I've realized as well. It's like, that's why I think people treat it like a game. Same with trading. Same with just financial success. Like these billionaires, for example. People sometimes point the finger and say they're greedy, they're this, or that. But the reality is, they're essentially just playing a game of innovation, of growth, of risk. They enjoy that game of it.
Totally. Absolutely. I mean, look at something like Jeff Bezos at Amazon. I mean, did he go out with the intention of becoming the richest man in the world? He probably had a dream about it, but I mean, realistically, he started in his parents' garage, or his garage. I can't remember what the story was, but it's because he developed the process. He took risk at the right time, developed the methodology, and built the business. The fact that he's a billionaire, yeah, it's nice, but it's the byproduct. The real genius is the generation of the business.
Yes. And I guess that can relate to the generation of the ideas and the
absolutely,
risk
absolutely. Yeah, the byproduct is what follows, but don't focus on the byproduct, because Jeff Bezos didn't just walk away with like $200 billion or whatever he's worth. You know, he had to get there by hard work and smart work and taking the appropriate risks and making the appropriate decisions.
Well,
and I'm sure to entrepreneurs and traders, guarantee you he made a ton of mistakes along the way.
100%, yeah.
Like I said,
So I mean, they suffered quite a bit during that Nasdaq bubble, no?
Yeah, totally. Trading, you learn from your mistakes, and the most important thing is to realize when to cut your losses, your stop loss, and when you have to be disciplined to cut your losses. Everybody gets things wrong. And anybody who says they've traded and never lost money is either never traded or total complete bullshit.
Fortunately, I feel like just like the markets, there's cycles to social media, and like there's periods of time where everyone seems to be on the sort of influencer and the fake trading narrative, but then there's periods of time where everyone's shunning that and promoting the real side. And right now we're going through that sort of period, which is good.
Yeah, that's cool.
And I think it's important. That's why I'm so happy that you're here today, because it's important to have people like yourself, people with similar experiences, and have that actual experience, actual experience, track records, and so on and so forth, to be able to share with the wider audience and the industry as a whole the reality, a reality check, and hopefully a pivotal change in their mindset and their thinking. And that's the whole reason we do this. And that's why I'm so thankful that you're here today. And one thing I was going to ask you very quickly, just back to our previous topic, was what did your kids think in terms of your YouTube? I know you have like 2 YouTube videos out there with the Institute, and they've done very, very well. Very well indeed. And then now you're here on another podcast. Like, have they ever seen them?
My kids have seen them, and they quite like them. But I think the problem, as the sort of with teenagers, is kind of it's surprising how many of their friends or people who knew them then discovered me on their YouTube. And they got very embarrassed.
Oh, really?
They're totally mortified.
Why? I thought it was good.
But
you look good.
Yeah, but as a teenager, if your mates are taking the piss out of you, it's like, because your dad's on YouTube, it was like, all right, granddad, you know what I mean? It's like, well, so they were mortified, but they've kind of come out of that circle now. That's fine. But I think they quite enjoyed it, actually. I think especially my 2 daughters. I think they were more into it than my
Did any of them ever want to get into trading at all?
I wouldn't be surprised if my youngest son does. But I think it was. I don't think they really have the interest in it. And one thing I try to do with my children is to encourage them to follow what their passions are.
Of course, yeah.
And their passions are not necessarily the same as mine, and vice versa. And that's totally fine. That's the way it should be. I think trying to pigeonhole your children to force them to get a job in the city, I think it'd be crazy. That'd be just totally wrong. Not because it's bad, but because
if they didn't want to do
it. If it's not their choice, then I think it's wrong.
Definitely, especially in trading, it wouldn't work.
I think almost by definition. The thing about trading is, I think, friends who are not traders, both when I was in London and now back in Newcastle, it's always portrayed as a very stressful environment. I never got particularly stressed, never lost any sleep over it. I think stress is caused when things are out of your control, where you can't control them, and I think that generates stress, and that can be very, very dangerous. I think appropriate risk management, where the stop losses are, and then you've got things kind of in your control. And I think one of the things about trading also, you've got to accept the fact that at all times there are going to be things which are beyond your control. The pandemic, as an example, nobody could see what was going to happen there. When we heard about some story in China that all markets would drop 25-30% over the next 2 weeks, that seemed like a bit off, a month or whatever it was. That's just out of your control. But I think if you accept that and accept that uncertainty, then you can tolerate it. So you have to. So that, I didn't find it particularly stressful. But I think trading, taking risk, seeing your P&L in black and white, that's not for everybody. I think the instant, the constant showing of how successful or unsuccessful your ideas or your trading is, or whatever it may be, that's not for everybody. And I think that can generate stress, so I think trading probably, if you can't let things out of your control, trading will probably manifests itself probably quicker than any other business. But it's not anything different. I think it's just the nature of the beast means it shows itself quickly. Does that make sense?
No, that makes sense.
I went a bit of a ramble there, but
No, it's good. No, 100%. No, it definitely makes sense, and I think it is so true, because I think with trading, the difference being is that with every other, even entrepreneurship or business, with trading, the difference is that there's always money on the line, and your emotions are so tied to that money, and emotions are so tied to every decision.
That's the point. You've got to. You can't tie emotions to it. Like I said, the markets are they're not emotional.
Yeah.
The markets couldn't care less about you. A price is a price. That's all it is. How you want to act, what you want to do with that price, that's up to you.
Yeah.
But there's nothing emotional about it. It's not like asking somebody on a date or whatever.
Yeah.
You know what I mean?
No, I remember someone said something to me once, and it really stuck to me, which was like, the markets are, what was it? It was essentially, it's very similar to what you said, actually, in terms of the markets being, having no emotion. But essentially what they said was that we trade the market, but we're not made to trade the market. Like, as human beings, we're not actually made to trade it, right? A robot's meant to trade the market, no emotions. However, the way to sort of, or the not the mindset hack, but like the way they sort of described it was, you're not trading the market, you're trading your edge, right? So you just got to focus on the edge, not the market itself. When your edge presents itself in the market, you then execute A, B, and sort of go analog like that, like a robot, essentially, to try and remove the emotion. But I think, as someone who's experienced the markets for so long, do you feel like the emotion over time and with your experience does dissipate, or is it more so that you just learn to manage?
I think it dissipates, but yeah, and also you learn to manage. Because I think this is the benefit of experience, where you see the same sort of cycles, the same sort of things, same sort of price action repeating themselves. You kind of, that's experience. You get a feel for it. But it's experience, so yeah, it's not so much of a lurch, but yeah, so you have to control it. The control becomes easier, but also it does dissipate. Doesn't completely go away, but it definitely lessens.
And in terms of like key trades, we'll just go back to the sort of the key period, especially like the Nasdaq period, for example. What was it like on the floor or in that?
Oh, it's crazy busy. Crazy busy. An investment bank at the time, so Goldman Sachs, the Nasdaq bubble in the late 90s was just crazy, because everything was just gapping higher and higher and higher. And yes, we all knew it was kind of crazy, but nobody tried to call the top. But the volumes were exploding, the absolute massive volumes. When the bubble unwound in the early noughties, the problem was kind of prices are going down, but also volumes collapsed. So that's the problem for an investment bank, is not necessarily the prices going down, it's just less business around. So you're not getting as much commission. It's more difficult to make money in a bear market than in a bull market. It's more difficult. It's not impossible. It is more difficult, but that's the yin and the yang, the good and the bad. That's the way you see the explosion and euphoria, and then you see the hangover, which is kind of, I mean, I would suspect we'll see it at AI stocks, but I'm not saying this is the top by any stretch of the imagination. Like I say, it could well be, but it could be another 3, it could be triple where it is now, it could be 5 times. I've got no idea. And trying to call that is a complete mugs game.
But do you just feel like there's a similarity there based on
Yes, I think there is definitely a similarity. I think also there's similarity in terms of the price action, in terms of how things are sort of kind of gapping higher. But also, more importantly, I think there's also just the fact that there's a narrowness to the performance. So many, look at the US, so many stocks have kind of flattened down over the last 12 months. That is not a very healthy market. That kind of flashes yellow for me, but again, I'm not short, so I'm not. But it's definitely not red, but it's kind of flashing.
No, it is interesting, because we saw it when there was a big rise a few years ago. I think it was maybe just past COVID. I think just past the COVID time, there was a huge emphasis on VR, right, the metaverse, and therefore all these. I don't know if there was VR stock related, maybe, but more so in the NFT realm, which is like an offshoot of crypto.
Yeah. Well, that's what I was talking about. I had no idea. No, it just didn't make sense to me.
Yeah, well, this is what
And
happened.
I'm sure this will probably happen again or something, but that's fine.
But that all blew up, especially around the whole VR stuff, right?
Yeah.
And then now we're talking like 90%, 99% declines off all-time highs, off across loads of NFTs, and even in the crypto market as well, to be fair. And it's just interesting that you're saying same thing with AI. It's like same with the .com bubble, right? The Nasdaq, right? We had
Totally.
It's a new technology. Everyone's so excited. All
Totally.
these crazy projects and applications and possibilities.
And also, who knows where it's going to go?
Yeah.
I mean, I would say the earliest example is probably the railroad stocks, or even the South Sea bubble, where Isaac Newton died bankrupt because he lost his money in the South Sea bubble, the Louisiana bubble in the French thing. This is like in the 18th century. The railroad stocks at the sort of the turn of the 19th, 20th century. Nasdaq, there's new technology, and nobody knows where this is going to go, and more importantly, nobody knows who's going to monetize it. Somebody's going to monetize it, but is it going to be the same expectations? History would suggest there's going to be some winners and losers, and it might not be as rosy as we all think. The sort of VR thing is a sort of, I think it's a bit, in terms of market conditions, it's a bit AI light, but who knows where it's going to go, and who knows who's going to monetize it, and where it ends up. I think it'd be, but you look at the crystal ball.
Is this what you love about the game, though?
Yeah,
these
totally.
Different dynamics,
Totally.
these introduction of new technology, new dynamics.
Absolutely. This is the enjoyment. This is what makes it interesting, and that's great. And there'll be another one along the line at some stage. Who knows when and what it'll be? I don't know, but that's the fascination.
So, what would you say to the sort of average retail trader? Because they're always one of the biggest feedbacks I get is that they don't know any of the traders. Right. Especially, obviously, of course, profitable or professional traders, but even just generally, they don't know.
I think
any traders.
almost by definition, sort of traders are kind of most of the sort of very successful ones I've ever worked with or have been clients of are quite low key. This is what makes me nervous about the sort of influencers who are sort of portraying a lifestyle in real life. Most traders are sort of, you would never know that. How much wealth they've got, or how their experiences, or what their thought processes are. That's not the reason why we do it. So I'm not surprised that retailers don't know traders, but I think that, again, I would mention the Institute of Trading, Portfolio Management, ITPM, because they're all experienced guys, and it's a correct education, and education is absolutely key. You can't expect to do this without any education.
And in terms of one question I ask some guests, to be fair, is what would be your top 3 tips to traders in terms of progress? I know we've mentioned quite a lot throughout the podcast, but if you were to nail it down to your top 3 tips to traders out there to make progress, to grow, to become more consistent, to be more disciplined, whatever it may be.
I think you need to focus on generating ideas. I think focus on managing your portfolio, and just back yourself. Basically, just back yourself. That's the most important thing. Just back yourself. And also bear in mind, nobody ever got fired for taking profits.
Yeah, that's very true.
But you just back yourself, do the work, generate the ideas, construct the portfolio accordingly, and back yourself, back your judgment. Because if you're not going to back you, nobody else is.
Definitely. If you could meet anyone from the past, whether they're famous or not, or even the present, just to spend time with, learn from, potentially, whatever it may be, who would it be and why?
Fucking hell, you got an easier question. I've got no idea. There's so many fascinating people out there. I mean, I've got no idea.
Who's
Absolutely.
the first one that comes to mind? Like a face is there. Who would it be?
Nobody really. I mean, it kind of that sounds like sort of. Ask me today, I'll tell you one person. Ask me tomorrow, but it'll be somebody else. I think it's I would say more importantly, like engage in the world today. That's the most important thing. Every day is a school day. You always learn something. There's always experiences and things out there. So I would just focus on today.
Yeah.
Don't worry about yesterday. That's gone.
That's true. It's very true. But Chris, it's been an absolute pleasure.
My pleasure.
Honestly,
Thanks for having me on
thank
the
you for
show.
sharing everything with us today. And everyone at home, make sure normally I have links in the description, but I don't know if there are any links. If you do have any, just pass them on to me. They'll be in the description. But if not, just drop a comment of your biggest takeaway from this episode. It's been absolutely incredible, a wealth of knowledge. And well, until next time, everyone, take care.